Hi, I'm Wallace. I'm the founder and CEO of Above Board Financial, and in this video, I'm going to talk about the taxation of brokerage accounts. Now, we are not tax advisors here at Above Board. We are an independent insurance brokerage. And so you might wonder, well, why am I making this video? And the answer is that to do good analysis of insurance policies, you need to do tax-aware financial analytics. And too often, I would say the insurance industry has a have a hammer, see a nail problem, where insurance is viewed as the right tool for the job in so many different situations. And I think the reality is that insurance can be great in a number of situations and is absolutely the best tool for the job for many cases, but not all, right? And so how do we tell the difference, right? How do we do facts-based analysis that reveals the right answer about whether insurance is the best tool for the job? Well, one of the ways that we do that, especially with any sort of permanent life insurance, is that we want to make sure that insurance offers a material benefit versus other stuff the client could have done with their money. And sometimes the question comes up of, well, how would putting money into a taxable brokerage compare to putting money into life insurance? So this video speaks to that. I'm going to go ahead and screen share here, and we are going to look at taxable brokerage accounts. Now, importantly, we're not going to be talking about 401ks or IRAs in this video. This is only for brokerage accounts. And when you have a brokerage account, you generally make money from either owning equities or fixed income. And we'll get to fixed income in a second, but equities would include things like S&P 500 or shares of Microsoft. You might also hear equities called stocks or shares. With equities, you typically make money through dividends and or capital gains. Now, dividends are typically cash payments that go out once every quarter to people who own the equities, and they're kind of like a share of the company's profits that it's being paid back to the shareholders. Even if you don't sell your shares, you still owe taxes on those dividends in the year when they were paid out to you. Now, with capital gains, you don't pay tax until you realize the gain, meaning you sell the shares. So if you buy shares at 50, sell them later for 80, your capital gain is 30. Now, with fixed income, if you're buying fixed income, you're generally expecting to make most of your money from interest income. There's also the concept of capital gains in fixed income. And it's the same idea of trying to buy low and sell high. But generally, you're expecting most of your money to be made with interest income. So what happens when you make money in a brokerage account? And you get taxed. And the question is how? Well, here's a page with federal tax brackets, and there's a lot going on here. So I'm going to pull up my laser pointer. And this slide is particularly for married filing jointly couples. If you're single, I'll show that slide in a minute, but I want you to do the same exercise that I'm going to describe now, regardless. So look at the left side of the slide here. These are the rates that apply for ordinary income or short-term capital gains. I want you to find your annual income as a couple. This is for married filing jointly. And observe the tax rate that applies for ordinary income or short-term capital gains. Once you've done that, come over to the long-term capital gains side of the page, find your household's income, and observe the tax rate that applies for long-term capital gains. Now, the vast majority of people will find that the long-term capital gains rate is a lot lower than the short-term capital gains rate and ordinary income rate. Then on top of that, if you're part of a household that makes over $250 a year, make sure that you're adding on that extra 3.8% tax on net investment income. Now, if you're single, I want you to do that same exercise, but pausing on this slide. So now you should have a general sense that long-term capital gains is generally going to be much more advantageous than short-term capital gains or ordinary income. And I also want to pause for a minute and highlight that what we just talked about is federal tax. If you're in a state or a local area that has its own income tax, you're most likely going to have to add those rates on top of everything that we just looked at. So for example, for me, I live in New York City. I have both New York State and New York City income tax to contend with. And typically at the state and local level, there's no distinction between long-term capital gains and income. It's just straight up tack that income rate for state or local onto whatever you did for federal. Now, with equities, when you get dividends, they're either qualified or non-qualified. Most US companies issue qualified dividends. Some large foreign companies do as well. If you have any question about sort of what applies to you, you'll find the answer to this on your 1099 form typically. But with qualified dividends, you get those nice long-term capital gains rates, whereas with non-qualified dividends, you're paying the ordinary income rates. With capital gains, you would pay long-term capital gains as long as you own those shares for over a year. But if you hold them for a year or less, you're stuck with the short-term capital gains rates that are higher. If you come over to fixed income, interest income is taxed at ordinary income rates. So you're stuck with those higher tax brackets. Capital gains, it works the same way as with equities, but again, capital gains are typically not the majority of the return on a fixed income investment. So come visit us at aboveboardfinancial.com to get some insight about whether or not insurance has a role to play for you, and to get facts-based insights and honest analysis of what really makes sense, so you're empowered to make a decision you'll be proud of for the long term.